HSBC Promise4 plan. Can this policy truly offer both financial security and wealth building potential for your family? Let us find out through an in-depth analysis in this video. Hi, welcome to holisticinvestment.in. We help individual investors like you to make the right financial and investment decision to reach your financial goals in a more faster and smarter way. Now, before analyzing this policy, let us first understand what is this policy is about. So, this is a non-linked par individual life insurance savings cum protection plan. And some of the key features of this policy are that it provides life cover throughout your policy term, and they also offer you with two plan options like savings for future and income for future to meet your financial goals, and there is flexibility to build anytime redeemable deferred survival benefit facility. There is also bonus in the policy to augment policy benefits, and there are tax benefits as per the applicable laws. So these are some of the key features of this policy. Now let's move on to understanding the benefits available under this policy. So first, let's take a look at the maturity benefits. Actually, it differs based on the two options. For savings for future, it is just your guaranteed sum assured on maturity plus any guaranteed loyalty addition or your accrued annual bonuses, or if any final bonus if you have any. All these will be accumulated and given to you as the maturity benefit. But if you have chosen the income for future plan, then at the end of the premium payment term, you will get a guaranteed survival benefit. So each year after the end of your premium payment term, you will get a guaranteed income plus a cash bonus if you have any at the end of each policy year. So at the end of the policy term, you will get a 100% guaranteed sum assured on maturity plus accrued annual bonuses plus final bonus plus any balance in deferred survival benefit. If you had any of these options and accumulated them, then you will get these as your maturity benefit. Now death benefit is same under both plans. So it can either be the sum assured on death plus your accrued annual bonuses, or if you had any plus interim annual bonus if declared, plus your interim cash bonus if any, which is subjected to a minimum of surrender value payable. If this is higher, this option will be given to you as a death benefit. Otherwise, 105% of the total premium paid till the date of your death plus balance and deferred survival benefit if any. So whatever benefit is higher according to these options, then that will be given to you as your death benefit. So sum assured on death is the amount that is higher of your guaranteed sum assured on maturity, or 11 times your annualized premium. So these are the benefits we get from this policy. Now if you take a look at the advantages and disadvantages of this policy. So let's start with the advantages. As a policyholder, you can take a loan of up to 80% of your surrender value, and also as an individual, you can select the plan variant which best meets your personal financial needs. And also a higher guaranteed sum assured is available with a higher premium payment. These are some of the advantages. If you take a look at the disadvantages, that it is, once selected, the plan option cannot be modified after you start the policy. So the returns offered in this policy seems to be comparatively low, and also the sum assured may be insufficient to meet your financial goals. So these are also some of the potential risks you might be undertaking, which you need to carefully consider before going through with the deciding to invest in this plan. Now, as we have a basic understanding of this policy, now let us see if this policy really provides both maturity and survival benefits which is sufficient for us, which helps us to build a financially secure future for our family by evaluating the returns we get in the policy, which is the internal rate of return, IRR. Because no matter the benefits and advantages, what matters at the end of the day is the returns we get in a hand. That's why we are going to calculate the IRR for this policy, which helps us, enables us to compare with other investment returns also to see whether investing in it will be helpful for us or not. So what we are going to do is, for example, let us consider a 40-year-old male has selected this policy with a sum assured of 11 lakhs. So the policy term he has selected is for 20 years with a premium payment term of 10 years. So an annual premium of 1 lakh under the saving for future option. So he receives the maturity benefit including any bonuses at the end of the policy term. So as you can see, just for illustration purpose, we have kept the assumed investment returns at 4% and 8%. These are not guaranteed or nor do they represent any upper or lower returns. This is just for illustration purpose. So as you can see from the example illustration, that with 4% return assumption, the maturity benefit would be 15.02 lakhs, which results in an IRR of 2.64%, which is more or less comparable to the interest rate you get in a savings bank account. So if you have kept your money in just your savings bank account or not invested anywhere, even then we will get a guaranteed return of similar to these only. So what is the purpose? But this is for the worst case scenario, like 4%. Now, if you take a look at the best case scenario, which is the 8% return, then your maturity benefit rises to 24.80 lakhs, which yields you an IRR of 5.94%. So as you can see, 5.94% is a return which fall below even typical debt investment return like FD. Even FD can give you a guaranteed return of 7 to 8%, but as these returns are not guaranteed, it can go even lower than this. And they are not sufficient, obviously, because we are putting so much risk and we are investing for a long term period to get inflation beating returns. But these returns do not seem to outpace inflation, leading to a potential shortfall in the funds which is needed to achieve your future financial goals. And additionally, the sum assured here also may be insufficient to fully support your family's financial needs in the future. So that's why what we are going to do next is we are going to compare the returns of this policy with other investments, with other investment strategies, just to see if we can get better returns following another strategy or investing in other investment methods, just to see if it's worth or not. So for comparison purpose, we are going to adopt a different investment strategy. Like we are going to separate the insurance and investment components using the same metrics as before, just to see if separating will give us better returns. So in the previous scenario, this policy included a life cover of 11 lakhs. So comparably, you are going to invest in a pure term life insurance policy which offering the same life cover, but it would only cost us 13,600 rupees for a 20-year policy term and a 10-year premium payment period. So this approach frees up 86,400 rupees annually for us, which can be invested according to our individual risk tolerance. So what we are going to do is we are going to take two options. One is for low risk investors, another is for high risk investor. So low risk investor might consider debt instrument like the Public Provident Fund PPF, which is a government backed product and it will give you guaranteed returns, and there are also tax benefits available under section 80C. While high risk investors could explore equity based options such as equity linked savings schemes, ELSS, where also you have tax benefits. And if you look at the track record of ELSS, you can see that if you choose to invest in it for a long term period like 7 to 10 years, it has in average given returns like 12%, more than 12% even in some scenarios. So as you can see, PPF requires a minimum annual investment of 500 rupees over 15 years. So in this case, the 10-year premium payment term requires adjustment in the remaining years. So we have adjusted accordingly. So the final maturity value in PPF is estimated at 25.49 lakhs with an IRR of 6.13%, which is a guaranteed return and also something which you can consider comparably safe return. With ELSS, the accumulated fund at the end of the term would be approximately 11.9 lakhs, which is the pre-tax amount. So after capital gains tax, the post-tax value would be 11.29 lakhs, which results in an IRR of 10.28%. So 10.28% is a return which definitely can outpace inflation. So as you can see, the term insurance and PPF combination and also the term insurance and ELSS combination yield potential returns that outpace inflation, and also this approach helps support our long-term wealth accumulation process, which is a benefit that is lacking in the Canara HSBC Promise4 policy. So what is the final verdict of this policy? As we can see from our analysis, in this policy, your premiums are paid for a limited period in exchange for life coverage and survival or maturity benefits depending on your chosen option. However, as from our analysis, we can clearly see that this plan lacks any distinctive features and the returns are low for a long-term investment, and it also has a high agent commission. Additionally, the sum assured may not adequately meet a family's basic financial needs. So as a result, the plan falls short of serving both insurance and investment purpose. So with subpar returns, limited life coverage, and no unique benefits, this policy may not be a suitable addition to your investment portfolio. For a more effective financial security, you can consider pure term life insurance policy with sufficient coverage, which is typically available at affordable premium. Achieve your life's financial goals, you can definitely invest in a diversified investment portfolio which is aligned with your risk tolerance and investment horizon, which is definitely essential. So keeping your insurance and investment separate can enhance overall financial outcomes and can even give you returns which can outpace the inflation. So definitely this is something for you to consider.
If you want to read more about this policy, then you can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.